Okay, so picture this. You're scrolling through your investment app. Maybe it's a lazy Sunday morning, coffee in hand, and you see an ad. It says something like, earn 10, 11, even 12% annual returns, backed by real assets, low volatility, available to accredited investors now. And you think, wait, the S&P 500 has been a roller coaster. My savings account is paying me basically nothing in real terms. My 60-40 portfolio feels boring. And here's this thing promising double-digit yields that apparently the ultra-wealthy have been using for decades. So you click, you read, and honestly, it sounds incredible. Stable, sophisticated. Like finally you found the thing that the big institutions use that regular people never get access to.
Here's the problem. That thing is private credit.
And right now in 2025, it might be one of the most dangerous places you can put your money, and almost nobody is talking about why.
I spend way too much time thinking about private credit and the systemic risks that are quietly building underneath the surface of the financial system.
If you're someone who's been tempted by high-yield alternative investments, or you've heard your financial advisor start dropping phrases like private debt, direct lending, or non-traded BDCs, and you're not totally sure what any of that means, or whether you should be worried, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because today, we're going deep. We're going to talk about what private credit actually is, why it has grown into a $1.7 trillion market almost overnight, and most importantly, why some of the smartest people in finance are starting to quietly freak out about what happens when this thing unwinds.
Let's get into it.
All right, so first things first, what even is private credit? Here's the simplest way to think about it. You know how when a big public company needs to borrow money, they can just issue bonds?
They go to the public markets, millions of investors buy those bonds, and the whole thing is transparent, liquid, and regulated.
Anyone can look up the price at any moment. Private credit is the opposite of that.
It's when a company, usually a mid-sized private business, needs to borrow money. But instead of going to the public bond market or a traditional bank, they go directly to a private fund.
A hedge fund, a private equity firm, an asset manager. That fund lends them the money, usually at a much higher interest rate, and that loan sits on the fund's books. No public market, no daily price, no easy exit. It's essentially shadow banking, but dressed up in a suit and calling itself alternative fixed income.
Now, for a long time, private credit was a niche corner of the market. We're talking maybe $400 billion in the early 2010s.
Interesting, but small.
Then something happened. After the 2008 financial crisis, regulators cracked down on banks.
New rules, Basel III, Dodd-Frank, forced banks to hold more capital and pull back from riskier lending, especially to mid-sized companies. Somebody had to fill that vacuum. Private credit funds stepped in. And then this is where it gets really interesting. Interest rates went to zero for over a decade. Institutional investors like pension funds and endowments were desperate for yield. Bonds were paying nothing, so they started pouring money into private credit funds, promising 8, 9, 10% returns. By 2023, the market had exploded to $1.7 trillion globally, according to data from Preqin.
The IMF flagged it as a systemic risk in their 2024 Global Financial Stability Report.
BlackRock, Apollo, Ares, Blue Owl, the biggest names in finance are all racing to grow their private credit businesses. Here's the thing, though. When everyone rushes into the same trade at the same time, history has a very clear lesson for us about what happens next. Let me show you why this product is so seductive. Because the marketing pitch is genuinely compelling on the surface. Say you're an investor with $500,000 to put to work. You've got a few options.
Option A, you put it in investment-grade corporate bonds. Right now, you're looking at maybe 5 to 5.5% yield. That's $27,500 a year in income.
Fine. Boring. Safe. Option B, You put it in a private credit fund. The fund promises you 10 to 12% net returns. At 11%, that's $55,000 a year, twice the income.
Same principle at risk.
On paper, option B is a no-brainer. And that's exactly why over $1 trillion has flooded into these funds.
But here's what most people don't realize. That extra yield isn't free money.
It's compensation for risks that are very carefully hidden from view.
Risk number 1, illiquidity. When you buy a corporate bond ETF, you can sell it in seconds. When you put money into most private credit funds, you're locked up. Some funds have quarterly redemption windows with gates, meaning if too many investors try to get out at once, the fund can literally stop you from leaving. We saw this with non-traded REITs in 2022. Blackstone's B REIT had to limit redemptions because too many people wanted out at the same time. Private credit has the same structural vulnerability. Risk number 2, valuation opacity. This is the big one. With public bonds, the price is set by millions of buyers and sellers every single day. The market tells you exactly what your investment is worth. With private credit loans, the fund marks its own book. They decide what the loans are worth. And because there's no external market to contradict them, they have enormous flexibility, some would say incentive, to avoid writing down bad loans for as long as possible.
Think about what that means. If a portfolio company starts struggling, the fund can keep the loan marked at par, full value, for quarters, maybe longer, while the underlying business deteriorates.
Investors see stable NAV. They feel great. Meanwhile, a slow-motion train wreck is building.
Risk number 3, leverage on leverage. Here's where it gets genuinely alarming.
A lot of private credit funds don't just lend out the money investors give them. They borrow additional money to amplify their lending.
And then the companies they lend to also borrow money from other sources. You can end up with layers of leverage stacked on top of each other, and at each layer, somebody is assuming everything will be fine.
When it's not fine, that's when you get a cascading collapse.
Now, you might be thinking, okay, but these are sophisticated institutional investors, pension funds, endowments. They've got whole teams of analysts. They wouldn't fall for something dumb, right?
And this is where the psychology becomes really fascinating to me, and honestly, a little scary.
There's this concept called herding behavior in behavioral finance. It's well documented. When uncertainty is high, even smart, sophisticated investors look at what other smart investors are doing and follow them.
As if everyone's doing it, it can't be that dangerous, right?
Wrong.
Every major financial bubble in modern history has been defined by herding behavior from sophisticated investors.
In 2006 and 2007, some of the world's biggest banks, Citigroup, Merrill Lynch, UBS, were loading up on mortgage-backed securities because everybody else was.
The yields were great. The models said the risk was low. And then, you know what happened?
Here's the thing about private credit that maps almost perfectly onto the pre-2008 mortgage market. The underlying borrowers, the companies taking these loans, are often businesses that couldn't get financing anywhere else.
They're too risky for banks. They're too small for the public bond market. So they pay whatever rate the private credit fund charges, and they accept covenants that are often described as covenant light, meaning there are fewer protections for the lender if things go wrong.
Loan quality has been declining for years. According to research from the Federal Reserve published in late 2023, the average leverage ratio on private credit loans has been creeping higher and higher.
We're talking companies borrowing 6, 7, even 8 times their annual earnings. That is not conservative lending.
That's how you set yourself up for mass defaults when the economy hits a rough patch.
And here's the psychological kicker. Most retail investors who are being sold access to private credit through BDCs or interval funds have no idea about any of this. All they hear is 10% yield and low volatility. The low volatility part is essentially an illusion created by the lack of daily mark-to-market pricing.
It's not that the risk isn't there. It's that you just can't see it yet. Private credit loans are almost universally floating rate loans. That means the interest rate the borrower pays isn't fixed. It moves up and down with benchmark rates like SOFR.
When rates go up, the borrower automatically pays more interest. Now, when private credit was exploding in a zero-rate world, this seemed fine. Rates couldn't go up much, could they? And then the Fed raised rates from essentially 0 to over 5% in 18 months, the fastest rate hiking cycle in 40 years.
Here's the math on what that does to a borrower. Take a mid-sized private company that borrowed $100 million at a floating rate of SOFR plus 6%. When SOFR was 0.1%, their total interest rate was about 6.1%. Annual interest payment? $6.1 million. When SOFR hit 5.3%, their rate jumped to 11.3%. Annual interest payment? $11.3 million. That's an extra $5.2 million per year in interest cost, almost overnight, for a company that was already stretching to pay its debt. For a business earning $15 million a year in cash flow, going from $6 million to $11 million in interest expense is the difference between barely profitable and genuinely distressed. Now multiply that across thousands of companies across the entire private credit universe. Look, default rates in private credit have been rising. Morgan Stanley estimated that the private credit default rate could reach 5 to 8% in a meaningful economic downturn, compared to the historical average of 2 to 3% in public high-yield bonds.
And because of the opacity issue we talked about earlier, by the time those defaults are officially recognized and written down, the actual losses could be significantly worse than what investors were told to expect.
Here's the part that frustrates me the most, and I want to be really direct with you here. For most of private credit's history, it was genuinely restricted to large institutions and ultra-high net worth investors. But starting around 2021 and 2022, the big asset managers started aggressively marketing private credit to retail investors through what are called non-traded BDCs and interval funds. They simplified the product. They lowered the minimum investment, in some cases to as low as $10,000 or $25,000. They hired armies of financial advisors to recommend them. Why? Because institutional capital was becoming harder to raise. The easy money had already flowed in. So to keep growing, because these firms get paid management fees as a percentage of assets, they needed a new source of capital. And the new source of capital is you. Here's what most people don't realize. When a fund sells complex, illiquid, opaque products to retail investors, just as the cycle matures and risks are building, that is a massive red flag. That's not democratizing investing. That's distributing risk to people who are least equipped to handle it right before the music stops. I want to be clear. I'm not saying everyone in private credit is acting maliciously. A lot of these fund managers genuinely believe in what they're building. But incentives matter. When you get paid more for raising money than for protecting it, things go wrong. Now, you might be thinking, okay, this all sounds scary, but people have been calling everything a bubble for years. How do I know this isn't just fear-mongering? A true bubble has 3 characteristics. 1. Asset prices significantly detached from underlying fundamentals. 2. Massive amounts of leverage amplifying the problem. 3. A sudden change in conditions that forces a reckoning nobody was prepared for. Private credit checks all 3 boxes. Will it be 2008 level catastrophe? Probably not. Private credit isn't as deeply embedded in the banking system as mortgage-backed securities were. The losses will be more contained. But more contained than 2008 is a pretty low bar. We could absolutely see a situation where private credit funds are forced to write down billions in loans. Retail investors find themselves with frozen capital and real losses, and a broader crisis of confidence ripples through alternative investments broadly. The IMF's 2024 assessment estimated that private credit losses in a severe stress scenario could exceed $300 billion globally. That's not nothing. All right, let's get practical. Because I don't just want to scare you, I want to actually help you make better decisions. If this video opened your eyes to something you hadn't thought about before, please hit the like button. It genuinely helps more people find this content. Subscribe if you haven't already because we cover this kind of stuff all the time. And drop a comment below. Are you currently invested in private credit or BDCs? I'll see you in the next one.